I'm Dylan Marma, and you're listening to Operators and Allocators, a podcast dedicated to exploring how to make smart investment decisions and execute well in real estate and private equity. We'll be interviewing top-notch sponsors from various asset classes to understand how they think and the frameworks that they put in place with the goal of achieving above-average risk-adjusted returns. Welcome back to another episode of Operators and Allocators. This is your host, Dylan Marma, and today I am joined by a special guest, someone that I consider to be a good friend, Chris Grenzig. Chris is a principal of JAG Communities, a vertically integrated multifamily group out of Jacksonville. He's participated at this point in nearly 4,000 units. He's formerly a stockbroker that found his way into real estate. And again, someone that I consider a good friend that I've become close to over the last few years. And I constantly reach out to when I'm running into issues, and we love to bounce ideas off each other. So definitely excited to have him on the show today. Welcome to the show, Chris.
Yeah, thanks for having me, bud.
Of course. So tell us how you got your start.
Yeah, I mean, like you said, I'll back it up slightly more. I graduated college in 2014. I kind of bounced around as a Division II assistant coach for a while, playing for soccer. And then while I was coaching, I ended up getting a job as a cold caller for a stock brokerage company. Got licensed, started doing that, but really disliked the industry pretty hard. Just felt like didn't care whether people made money. They just cared about commissions, and that didn't really sit well with me. I had a family member ask if transferring their holdings to me would help me, and I just wouldn't even take their money. I was just like, I feel like it's just not going to go well. So once that happened, I was like, all right, we're done. We got to figure something else out. So it just so happened while I was doing that, my cousin bought a flipping course and asked me if I wanted to come along. So I went to like the weekend seminar and really enjoyed it from the get-go. I mean, I knew literally nothing at the time and just thought it was super interesting. So we started trying to flip houses on nights and weekends, failed for several months, started networking a bunch, and then met John Cohen, who is one of the owners at my last company I worked for called Toro. We partnered on a couple smaller deals, about 100 units across several properties. And eventually I left my job as a stockbroker to go work for them. So they kind of coached me up, started as like kind of just an asset manager helping out a lot of stuff, but it eventually evolved into a role where I was running the Florida region of the portfolio. So while I was there, Toro bought 4,000 units. We bought 1,000 down in Florida. I kind of ran the whole thing from, acquisitions, asset management, kind of helping source the debt, helping source the equity, the insurance, investor relations, and then, selling 2 of the 7 assets that we bought. So it was a really good experience. I was there for 4.5 years. And then November of 2020, I decided to leave, go off on my own. I was in the process of closing a 16 unit down in Jacksonville, Florida, where all of our Florida assets were, and decided I was going to move to Florida and self-manage, build a vertically integrated company while doing that. So moved down Thanksgiving weekend, started renovating and managing that, just kind of teaching myself that side of the business. And then a few months later, was fortunate enough to get a 24 unit deal not far from there that I really liked, was able to close on that. And while I closed that, I inherited my first 2 hires. So an internal manager and maintenance person. And that's kind of where we're at now. So we've owned that second asset for about 3 months. So I've been off on my own for about, 7-8 months now. Got 40 units total worth about $3 million. And just been working on kind of the business and everything else. And right now my 10-year vision is to have 500 million in assets under management.
Awesome stuff. I think that's a great litmus test if you're selling an investment or selling anything really, is would you feel good about selling it to your family? If you're uncomfortable raising money from your family, you probably shouldn't be raising money from anyone, because there's probably something to be said about that. So I think that's a great way to identify that this wasn't for you, and then find your way into something that you felt overall better about.
Mm-hmm. That's why I like all the real estate stuff, because I have my money in it. I have several family members in it. My partners on those first 2 deals off of my own is close family. So it's like, I have no problem whether I'm not forcing anybody. I'm not even really pitching it, but if they want to do it, I have no problem taking it because I believe in it. I'm putting my own money into it. And, I just feel a whole lot better about it. So I'm really happy I made the switch when I did, and really happy where I ended up.
Completely. So what inspired you to put yourself through the joys of self-managing?
It was a few different things. So when we were closing that 16 unit, I wasn't even going to leave originally. I was just going to buy it on the side and have somebody else manage it. But I was 28 at the time, turning 29. And I kind of just a couple people had asked me if I was leaving. And I was also on this kick of like, hey, more people should be buying in their backyard at the time. I still am, but be that as it may. And I kind of just got the idea stuck in my head of like, hey, let's go off on our own. Let's start a business. Let's self-manage. Let's try it. And I was really struggling to come up with reasons not to do it. And the biggest ones were kind of most of my family's in New York still. My sister is in Florida and my mom's in Florida part-time. So at least, my closest family, 2 of the 3 are there. But it was really just the only reasons I could come up with not to was kind of fear. So I was like, I felt like if I turned 80, 90 years old, I would regret not doing it. So I said, let's try it. The reason to move and self-manage was I had always felt that a big part of the gap in my knowledge was the operational side day to day, as well as the construction side. And I felt by coming down to Florida and doing it, I would figure it out one way or the other, but it would also help fill a lot of those gaps. And I said, worst case scenario, I absolutely hate it. I hate working for myself. I hate self-managing. I hate Florida. I said I could just move back to New York or somewhere else, get a similar job, and I would be better off for it because I would have learned some stuff while doing it. And it would only make me better at the stuff I was doing. So for me, I was kind of like, let's go try it. And worst case scenario, we can just pivot and move.
Yeah, completely. And I feel that the time that I've spent self-managing and close to this side of things has made me tremendously better at underwriting and budgeting and planning because you're more aware of all the moving pieces and what actually goes into it versus just looking at a P&L all the time. And I think recently I've had the epiphany that self-managing is painful, but there's always pain in property management. It's just that when you're that further away from it, you don't see it all of the time. What do you think?
Yeah, I think I have a better understanding of how things work, right? I used to get pretty frustrated that when you took over property, it would take some time to for things to really start going. And I always understood hey, it's a new property. People are figuring things out. But now that I've really gone through it, I'm like, okay, hey, the first 90 days, there's a lot of shit going on. There's tons of moving pieces, and it's not always the easiest thing to hit the ground running with renovations and improvements. If you've got, if it's a big enough property, you got people working on site, it's hey, just figuring out where the mail comes in, making sure keys work, making sure Wi-Fi works, making sure, all the software is set up correctly, just figuring out what to eat for lunch and where stuff is, how to get there in the morning, how to leave at night, where there's so many things. If you think about just starting a new job, I'm sure most people listening at one point have changed jobs, and you think about all the things that goes into it, that's going to set you back a little bit. And then you're trying to make improvements. And, now it's a change for the tenants as well. There's just a lot of moving parts. So I think being in it has opened up my eyes a little bit of how much of a people person business it is. And not that I didn't know that prior to, but I got pulled in by a resident for 10 minutes the other day because she was just showing me stuff, which isn't that big of a deal. But if you have a big enough property, that stuff probably happens all the time. So it's just little things like that, I think, are making it more apparent. And I think a lot on the operational side of how long, the average turnover time it takes. And then I can, kind of track that in the future. And if something's taken too long, I can figure out what the problem is. I'm still a little early on that. I don't really have that down where I've had enough reps at doing all of that I can say hey, if it takes longer than 2 weeks, there's a problem. It's either the rent's too high, the unit's not in a good condition, someone's not doing their job, whatever. But that stuff I think will start to come over the next couple of years.
Mm-hmm. Yeah, you almost develop a sense of grace for the chaos that goes on and the time it takes to execute on the business plan. So
yeah, for sure.
agree. So what does your deal criteria look like today? And you can apply this to specifically what are you looking for, or where do you believe the opportunity is in today's market?
I still really like, multifamily. I've never really done anything else. We've dabbled in mobile home parks. I've looked at some other things. So I think, there's opportunity in anything, but I still like multifamily just from the risk reward of, you've got a business that you have where the demand for the product you're selling, which is, housing that people live in, far outweighs the supply. It's just, where else do you find that, right? And that's why you have such like crappy looking apartments that rent, or bad management companies, because people need the product. It's not like you're competing against Amazon where your customer service has to be number one. It's pretty easy to find somebody to rent because everybody needs it. So for me, I'm like, okay, that eliminates so much risk of like, okay, well now, it's really tough for your income stream to go down if you do all the things you're supposed to do at a bare minimum, right? Not even like doing well, just do them, right? Like make sure the lawn is cut, make sure the trash gets picked up, make sure bills get paid and people pay on time, and you'll be okay. So for me, it's like, that's really great, because when you look at, retail or self-storage or office, hospitality, like I just feel like it's easier for your income to get taken away. I could be wrong, but that's just my opinion. So I still like it from that standpoint of, it removes a lot of risk, and that's big for me. I'm really risk averse. I don't want to add unnecessary risk unless it's, ridiculous upside, but I'm not really looking for that. I'm in it for, 10, 20 years. But something where we can come in and take something old and make new. So some sort of value add, opportunistic stuff, where we can come over and just renovate basically the entire property, because I want to refinance out as much capital as we can, cash flow it for several years, if not decades, and just kind of repurpose that equity into new stuff.
Mm-hmm. So it sounds like you're mainly focused on something that needs a little bit of a facelift of some sort, something that has some kind of upside, usually at least probably 10 years or older, right? I would assume. And as far as your take on markets, what do you think is the best strategy for investors to take when it comes to markets? Do you chase the deal? Do you chase the market? How concentrated are you?
I personally think you've got to be really niche down to find really good deals. So I was chatting with somebody and they're like, yeah, I buy 100 plus units up and down the East Coast of the United States. And I'm like, that doesn't tell me anything, because if all of a sudden I hear somebody has a deal and it's 100 units in, Charlotte, and it's this and that, I'm not thinking of that guy because he buys literally anything. But in that, he may also not buy everything. You know what I mean? Like, it's too broad. Mm-hmm. So like for me, when I came down, I was very specific on the types of properties I want to buy. One, because when that comes up, somebody can send it my way. And two, if I stick to a certain criteria, it allows me to eliminate a lot of deals very quickly. Now, some of them I'm willing to bend on more than others. But some of them I'm more strict on. So you just gotta come up with your criteria and figure out what's the most important and then what's not. Like for me right now, going into this, I was pretty okay with the vintage. Like I wasn't really like, hey, I want it to be built in a certain time period. And now that I'm kind of going through this, I'm a lot more interested in newer built stuff. Now, the problem is a lot of the properties that are between 20 and 80 units are older. There's not a lot of 1990s and newer stuff built that's 20, 50, 70 units. Most of it is built back in the 50s, 60s, 70s, maybe in the 80s. So I'm a little bit limited that way, but I'm starting to, as I'm going through this, be like, okay, I'm less interested in the 60s and 70s built stuff, and I'm more interested in the newer stuff. So I'm kind of toying up with that stuff right now. So it's always evolving and changing as you go through stuff.
Mm-hmm. I probably could find a better analogy, but I think of it similar to a puzzle. If you've sat there and you've been working on a puzzle for 5 hours, you start to see these little details and things that you would never have seen in the beginning. And it's very similar if you stay focused on one market for long enough. If you're looking at every single deal that hits the market in Jacksonville, like you said, you're going to quickly be able to pick up on how does that look on pricing comparative to other similar unit types, right? What are the things that, what are the residents in that part of town looking for? Does it have the proper amenities and things along those lines?
Mm-hmm. Yeah. And look, by the nature of my goals as well, I'll have, eventually I plan on scaling up into larger assets and as well scaling into more regional. So maybe going into St. Augustine or Daytona or Orlando or Tampa or Tallahassee or Savannah or Atlanta, things that are not too far away, but somewhat closer. But, I'm not looking in Phoenix because then I would be, it's a freaking 5-7 hour flight and, I'm buying smaller. It would never make sense. But same thing, like I got sent a deal in St. Augustine, but it was a little bit smaller than I would have liked. And it's just a little bit too far away from me right now. And I said, look, if it was, 50, 80 units, it'd be more worth it. But when it's 10, 20 units, it just doesn't make sense. Because even though it's not that far and it's technically part of the Jacksonville MSA, it's still a 45-minute drive for me. So God forbid anything goes wrong, it's a little too far and, just not enough to sustain any sort of staff or office or anything close by. So just, those things you kind of got to give and take on.
Completely. What do you see as the biggest risks in multifamily today? What would you caution investors that are less experienced against jumping into?
I would say the biggest risk is CapEx. If you're buying, especially if you're buying older stuff, stuff breaks, like it just eventually just hits, for whatever reason, just hits its shelf life and you got to replace it. Like the first deal we bought is built in the 60s and we've got a pool and I'm probably going to have to replace all these gutter cups that I didn't know about because I've got this leak in this pool. So I've got one bid for like 12 grand right now. And I'm trying to see if I can find something cheaper because it seems crazy to me. But like, those things just happen. So you have to budget accordingly. You really have to pay attention to the little stuff because it can add up over time. And just understand that even unless you take it to the studs and replace everything, it's always going to be an ongoing thing. And a lot of people will throw like 200, 250, 300 bucks a unit in for CapEx a unit. And that's never enough. It's like never 400 or 500 a unit a year. Mm-hmm. And even then you may have stuff that goes old. Like we also just had an AC go, I'm going to have to replace a whole new system. That's going to be like $2,000. So, and it's more expensive because the condenser's on the roof. So it's like, it's going to cost me extra. So it's like, those are the things that will kill the deal, because if I came in and I had a significant budget to repair stuff, so we'll be fine one way or another. I can just move money around. But like, if you don't have a huge budget and you're like, hey, I'm just going to cash flow. And then all of a sudden, more repairs come up, or you're like, hey, I'll do renovations through cash flow. Well, if all of a sudden, stuff isn't renting or something like COVID and people stop paying, and then you can't fund something that needs to get fixed. And then if that thing needs to get fixed to get you income, well, now you're in like this downward spiral. That's really the biggest risk I see, of people not being well capitalized enough for a lot of these older properties.
Yeah, I think that's huge and something everyone should be paying attention to. If many pro formas today have $400 a unit for repairs and maintenance, inclusive of turn costs, and then maybe $250 per unit per year in your actual reserves, right? And you see these skinny numbers that are getting thrown around, and sometimes these are professional operators that are using those numbers, but you have to look at how much cash do they have on the sidelines that they're considering CapEx improvement budget, and they're looking at it from a quick flip perspective. So they're really just trying to show as high of an NOI as possible by showing everything as sort of a CapEx expense. So I think definitely having a grounded sense of reality on what the actual CapEx looks like, especially on the older vintage product, is a great way to not lose your shirt.
Yeah. And I think it depends too, right? Like the first deal that I bought, we're spending like 30 a door renovating. So probably once we're done literally doing every unit, our R&M turn reserves should in theory be lower, right? Because we're putting in vinyl floor, we're replacing the entire kitchens and bathrooms, doing a lot of exterior work, doing all new plumbing. So it's like those things in theory over time should come down and should be less. So if you buy something that was just, got renovated, yeah, in theory, your R&M and stuff should be lower. But if you're buying a normal 60s, 70s. Even now you're starting to get, 80s stuff that was built and nothing's been done in years. Like if somebody's owned it for decades and they just kind of like fix stuff as needed, make sure you have enough money, make sure you throw a contingency into that money, maybe even, double your contingency than usual because stuff's going to break.
Yep. Definitely agree. What's one unpopular opinion that you hold present?
I kind of alluded to it before. I still think it's a kick. I see, and I think it's only going to start growing as we're seeing people move away from the big cities. There's a lot of people that don't live in your top 5 metros that are like investing out of state. And I don't know why they're doing it. And it feels like it's the cool thing to do. And it's like, oh, well, you can invest from anywhere, so you might as well. And I get it, right? But if you live in Florida and you're investing in the Carolinas, that's just dumb to me, right? Because the Floridas and the Florida, Carolinas, Tennessee, Georgia, Arizona, Texas, I don't know the Western states as well, but like there's probably like 10, 15, 20 states that all have like similar demographics. Now you might go to different pockets within those states or whatever, but if you're not in like a New York City, LA, Seattle, Northeast, whatever, or, an unfavorable landlord state, I think people are too quick to go out of state because it's easier. And it's just like, less. So it's easier to make a mistake, like I've learned so, we've been investing in Jacksonville for 5 years, maybe 4 years, 4.5 years, we'll say. I've learned so much more about the market now that I've lived here in the past 7-8 months than I did when I was in New York and coming down, 4 to 8 times a year. And it's just like, once you're in an area, you start like, you talk to people, you hear things, you learn more, street by street. And I think so many people know too much about their area. So when something comes up in their area, they know what the real story is going to be. They know their real story, they know the real area, they know what the rents can be. And then they go out of state and they don't know anything. So it's easier to be like, oh, well, this property 6 blocks over is getting that rent, but in reality, there's a train tracks and it's different on either side, or it just changes.
Yeah, and there's a project next door that you didn't realize.
There's some reason why that one can't do it, and I think that's a big problem. So I don't think it's a huge problem. Like I don't think it's a massive trend that I think needs to change. I think overall, I hear too many people too quick to go out of state.
Yeah, I think that for many that are looking at a market out of state, they can see good statistics online and they go there and they're seeing through these rosy goggles of how great this city is. And like you said, they miss the stuff that would be that they would easily spot in the places that they're living. They know all the problems, right? So there's almost like the ignorance is bliss type of mindset going in, just thinking, oh, this can't be that bad, right? Until they actually know there, and then they uncover all the cobwebs once they're actually invested, and that can be dangerous. I would say that, in my view, the golden age of multifamily syndications that started maybe 10 years ago, I think really pushed a lot of people to go and buy back when they could buy in a top MSA at a 7 cap with upside. And now there's not the same level of margin for error there. Do you think that's part of it?
Yeah, I think to a certain degree it plays in. I think too, commercial real estate's massive, right? Like there's not that many multifamily syndicators that are doing it that, we're changing the game, right? The REITs still own them, the REITs, the massive funds, whatever, they still own the majority of stuff. So it's like, I still, and this is just my gut. I just think I would be shocked if that online community has changed things so much that it's made a dent. Cause you do still hear about, massive funds coming in and paying for these, really record low cap rates, or I don't know if it's record low, but really low cap rates compared to 5 years ago. So I just think it's, the market sets the rate, the yield, right? And it's just, there's a lot of money that wants to get into it, and COVID's just pushed more money in, right? we had a year of powder sitting, nobody could buy anything, right? We've been hearing for years that these funds and whatever have all this money on the sideline. But that's while stuff was transacting. Then we just had a year of like next to nothing transacting. And then you have all this money also apparently coming out of these other asset classes, whether it's, hospitality or office or retail. Now looking for that, it's just like, well, if everybody wants it, it's going to drive up the price, whether you think it's worth it or not. So I don't know. The market for me just determines the value. Whether you see the value is going to maintain in the future is, up for debate, but it is what it is. And interest rates are low. And, there is, like I said, that asymmetrical relationship on supply and demand. So, I understand why it's so coveted.
Yep, completely. And I think it's really good to put it all into perspective, because many people can sit here and see these online educators recruiting people to learn how to invest in multifamily and blame them for moving the market. But when you realize that there's trillions of dollars of apartments available in the grand scheme of things, these guys that have a few thousand, even if you created a few operators that are doing a few thousand doors every year through these different programs that are out there, it's not moving the needle, right? In the grand scheme of things.
Yeah. And I mean, too, I'm not fully set on this, but I'm actually pretty bullish on cap rates staying low. And the two reasons I feel kind of and I'm not saying this 100%. I'm still formulating this and talking to people, but kind of if I'm leaning towards one way or the other, two reasons. One, if we get a bunch of inflation, cap rates will stay low, values will go up, rents will go up. I'm already seeing it now. Florida's freaking stupid. Rents just keep going up and up and up because people keep moving here and there's just not enough supply and demand. But, for me, if it was like, okay, well, your value is not going to maintain because your cap rates are going to go higher, right? Say from 4.5 to a 6, right? If that's what you're concerned about. Well, something would have to move it. And if it's interest rates, well, interest rates are going to go up because there's that inflation, because there's so much inflation, they feel they have to move it up. Maybe they move it up slightly because they just feel it's too low right now, but you'd still have to be in such a good place in the economy that they would feel comfortable moving it up. So, if there's that much inflation, well, your rents are going to be so much higher than you projected. You should be okay with a higher cap rate. Maybe you don't hit your 20, right? Maybe you hit a 15 or 12. Okay. Like, if I projected a 4.5 cap rate and went to a 6 and I made 12%, I'd be pretty damn happy. That's, that's kind of a really big swing in value and you still make money. That's pretty damn good. The other thing too is if you're buying with the right debt and for fixed costs, you're still cash flowing every single year. So even if you broke even or lost a little bit of money on sale, you're still making money. You're still on a hard asset, which, traditionally does well when there is inflation. I don't see how there's not going to be inflation. I don't get it. Unless somebody can explain it to me. I haven't heard yet why there's not going to be with all this extra money. But I don't know. I don't know where else it's coming from. So it just seems like a good place to be. So, look, I'll still underwrite some cap rate expansion, but I'm not going to be out here writing deals to a 6.5, 7 cap because that's ridiculous. You won't buy a single thing. So I wouldn't be surprised if we stay in a pretty low cap rate environment or there's other forces at play that counteract any cap rate expansion. Yep. Now, I'm not saying, buy a 4 cap and underwrite to a 4 cap, but, I think I'm less concerned about having to underwrite deals to, a 6 cap than I was in years past.
Yeah, I think if you're buying real estate today, you have to be placing a bet on interest rates staying relatively low, or at least to your point of if they increase, 150 bips or something to that degree, you can at least hold it beyond that or refinance or still have an exit where you come out alive on the other side.
Yeah. And the other thing too is, when I'm looking at deals, I'm not trying to renovate 20% of units and flip out of it in 2 years, which I would be more concerned about. For me, I want to renovate the entire property to a decent, I'm not trying to, make everything to an A+ luxury and you've got no space, but, take care of the big deferred maintenance items and renovate to a decent level, refinance and hold for 5, 7, 10 years. And after several years, you'll have some sort of value for the next buyer, be it through, loss to lease of you're not trying to maximize rents, because now, if you've refinanced out, you care a little bit less about pushing rents to the market and more about keeping it occupied, because that's how you're going to maximize cash flow, keep your turnover low. Also, just it's easier to manage, right? Just less, when somebody leaves, you've got to do all this work to get it leased back up. If somebody stays and pays, well, you're set, right? There's very little work to do. So as a self-manager, I want to make as much money as I can doing the least amount of work. So I want to keep my property filled with the people that are already in there. Eventually over 2, 3, 5, 7, 10 years, there'll be some loss to lease that a new owner could recapture. I'm sure there's some sort of value add that could be done, because we're not going to be reinvesting back into the property. So whether it's, new smart home technology or new trends in design or new, who knows, right? Maybe it's better technology with in-unit washer dryers, which we may not have in some properties, different things, a new buyer can capitalize that. That also makes me feel good about projecting a lower cap rate, because there's value for somebody to capture. Thus, in theory, you can get a lower cap rate because it's going to be value add for them. Yeah. When you start doing like full renovations and trying to flip out of it in 2 years, who the hell's buying a brand new renovated 1970s building for a 4.5 cap, 5 cap? I don't know. I'm sure as hell not. I don't know anybody else that is.
Well, I think that's one of the beautiful things about multifamily that often gets understated or overlooked, is the fact that every 7 to 10 years, just by the nature of the beast, there's going to be some kind of inherent value add, because it has either not had rents pushed, optimized to market to the T, or there's some kind of deferred maintenance, or just simple trends in basic aesthetic attractiveness of the interior of the units, right? They go out of style. So if you look at self-storage, if you look at mobile home communities, if you look at billboards, for instance, they're not changing. It's going to be the same thing it is today in 20 years from now. And that's why there's more of a threat of true consolidation, because it's generally not that hard to keep it remaining optimized once it's there. Whereas with multifamily, I think that's why it's more of an asset class that tends to have more of a trading sort of component to it, because people do get comfortable owning it. They stop pushing rents to the T, they stop doing the upgrades, and then there's some kind of value in it for the next guy.
Yeah, no, I mean, look, it's very easy to buy, an industrial product or self-storage product and sit on it for 10 years. I think it's a little bit tougher to maybe do that for multifamily, unless you're buying class A, brand new stuff. You've always got to do some sort of work to it.
Yeah, it's an active business. How do you source most of your deals?
Networking. I try to speak to anybody and everybody and let them know what I want. And that's why having that more defined criteria allows me to stick in people's mind. I will probably, I've done a little direct mail cold calling, and, what I plan on doing over the next 6 months probably is like handpicking like 5 to 20 properties that I definitely want to buy, like based on location, vintage, value, whatever. Like be very thoughtful and like go after those properties like very intimately. So like call myself, real handwritten letters, whatever. And then just other properties, I can only deal source so much, right? I'm basically a one-man shop. I've got a couple of people helping on the property management side, but on the capital side of finding deals, raising money, closing on them, whatever, basically a one-man show. There's only so much I can do. I'm happy to pay a wholesaler, a broker, deal finder, whatever, to bring me a deal that makes sense, right? If the deal works, the deal works. So by having it out there more of like, hey, I'm looking for, these types of deals. Here's my criteria. It's very well defined, constantly checking in with people, networking. I think that works really well. It's how Toro found some of their best deals, and it's how I got basically both of my 2 deals here. So, that's it. It's worked the best for me.
Yeah, that's great. I think there's a lot to be said about being very clear about what you're asking and putting it out there in the universe, and then being on the forefront of people's minds when they see that they have something that's a good fit. So let's talk about operations. What do you see as some of the best bang for your buck value add pops? What are some things that when you're looking at, a B or possibly C class property that is got deferred maintenance, it hasn't been touched in 15 years, 20 years. What are some of the immediate things that you're gravitating towards doing to be able to boost value, make it more attractive for residents that are moving in?
Mm-hmm. I don't know if this will apply as much to like the larger stuff. So call it the 100, 150 units plus, because I think once you get up to there, everybody does a pretty good job of keeping the property clean, well maintained, whatever. It's pretty, unless you like really find a dog shit property. But in the space that I operate in, you would be shocked at how bad some of the marketing and rent ready stuff is. Like, I've already had several people when we've showed units be like, wow, this place is so clean. Like, this is the cleanest place I've been to all day. And it's like, I'm very fortunate because I have Kelly, who's my like on-site. She's very meticulous and does an incredible job of going through at the very end and making sure everything's like clean and tidy and stuff. And I think that really translates well. I think keeping the property as clean, keeping it clean, keeping it functional. Like, nobody wants to come home to just trash, even if it's just like a few cups and litter and bags and stuff. Like, nobody wants to see that on their stuff. So it's, having, the landscapers, when they come out, pick up stuff. When you're out there, just pick up random crap. When your team is out there, pick up stuff and just throw it in the dumpster or the trash. I think that stuff goes really far. I think communication is a big one too. People want to know what the hell's going on, especially if you're going to be doing renovations and improvements and stuff. Nobody wants to not know what's going on. And, there's only so much you can do, right? To a certain extent, contractors show up when they want, and flooring guys, everybody has their own schedule, and you can't always get everybody's thing. But when you do know when people are doing, just keeping people in the loop of what's going on, good, bad, or indifferent, I think is helpful. So it's not the easiest thing. It's been one of the more frustrating things for me because I feel like I don't give enough communication to people, where it's like, hey, the plumber just showed up and fixed it. I'm like, well, they were supposed to tell me so I could tell you, not they showed up, they fixed it, and you tell me that they came. So some of that stuff does get frustrating, but I think, clean, safe, communication are all kind of the non-traditional, renovate a unit, push rent $100, $200, whatever it is. I think that stuff goes a long way. I think it also goes a long way to keeping tenants too. Which again is what I was talking about earlier. You keep your property full and you have no turnover. Well, you're going to have a really good cash flowing asset for the most part.
Mm-hmm. Yeah. It's a good reminder that it's not just about thinking about what am I going to do to the countertops or to the appliances, or what kind of siding are we going to put on if you're doing something with the siding or exterior. It's a lot about just having good rhythms, because especially like you said, especially on, if you have a 50 unit property or something in that general range, there's all kinds of stuff that goes on. I mean, I've had it too with third-party managers. I show up to the property and it looks like the lawn hasn't been mowed in over a month. And now I'm putting cameras in place so I can keep an eye on them and make sure that doesn't happen again. But, I'll be focusing on all these major CapEx projects and things that I want them to execute on. And it's like, they'll do exactly what I say there, but not a single thing outside of that scope. So if they're not doing the basic stuff like cleaning the hallways and, making sure the lawn's mowed, making sure the trash is not piling up outside of the dumpster, power washing the building every so often, right? Like, these are the simple things that make a tremendous difference. Because if someone comes and tours it and your lawn hasn't been mowed and it looks like no one's keeping an eye on the dumpster and there's all kinds of junk in the hall, like, that's going to give a really bad picture, and that can kill the deal right there.
Yeah, for sure. Look, I think, we had, Toro had a deal that we were in the middle of renovating, and we were getting feedback that people were showing up for tour, like people were setting tours. They would drive up and then they would either not show up or cancel, and basically be like, hey, we saw the property and we don't know, thank you anymore. And there wasn't really a whole lot we could do because we were doing stuff to the property and trying to lease at the same time. But like, that stuff happens. So like, just because your marketing looks great or whatever, and like, it looks like the best thing ever, if you set a certain expectation, then you don't meet it, people are going to be pissed. They're not going to rent. So it's like, you just got to set that proper expectation and then keep up with it.
Mm-hmm. So we all learn from either our own mistakes or the mistakes of others. One goal of this show is, of course, to help listeners do the latter and learn through other people's mistakes. What is one painful learning lesson that you've made that's worth sharing?
Yeah, I would say the biggest lesson that I've learned is, or it's just something I've got to be better at, is kind of changing from something that's not working quicker. I was going through where I had this one supplier, and the rep for that supplier for parts for renovation was just trying to get orders, trying to get things delivered, trying to get it ready to go, and orders not being right. And it took months, and the first couple times through, I was making changes, but it was just errors on errors on errors. And what I kept saying was, well, once we get it right, it'll be the same for every unit, so it'll be fine. And I was just like, once we get through it. And then it was like the order came in and it was just a disaster. It was just still stuff was wrong, and just problem after problem. And then eventually I was like, all right, whatever, enough. So I would have saved myself a lot of headaches if I had just seen it wasn't going right and just made the change earlier, because it never got better. So eventually I learned it. I'm still figuring out when is that line and when do you kind of cut ties and move on to other things. But I think that was one of the most painful things of, like, kind of like that sunk cost fallacy, right? I was like, well, we're so close. I spent all this time with this person, and, if we just get it right, it'll work out. And then, it just never really did. So I think that's one of the bigger mistakes and things I'm still trying to figure out of, like, okay, when, at what point do you just say enough is enough and kind of move on to somebody else? So, I think that's something I am still working on and figuring out as well.
Yeah, it's the whole hire slow and fire fast mentality in many ways. And I think that applies to vendors as much as it can to team members that you're bringing on, is making sure you're taking the right actions. But on the flip side of things, you also have to watch yourself from I've been guilty of trying to over optimize and trying to switch to the latest and greatest software program or vendor or something like that at the cost, to hopefully either save a few minutes or save a few dollars along the way. And then I'm spending too much time transitioning from one thing to the next. And if you have something that works, it's almost, if it's not broke, don't fix it type thing, right? So you have to definitely audit it and determine whether you're trying to over optimize yourself. Is it really necessary, or is this really a pain point, and can it be better?
I think it's two sides of the same coin, right? You've got a system and it's either working and you want to make it better, or it's not working and, or close to working. And when do you change part of the system or whatever? And it's, you're trying to, your business is all just a series of systems and workflows and all that stuff. And, like any good business, you're always trying to get better. So if it's not working, it's when do you cut ties? And if it is working, when is the right time to actually improve on it? Or when is the time to say, hey, this is good enough, type of thing. So yeah, I think it's very similarly related.
Mm-hmm. What is one recent success that you're excited about?
We got, for that first property, we finally basically got renovated and leased up that first unit, $75 higher than I had originally projected. So that was really, really nice, where it was like, I was unsure what it was going to rent for going into it, because it was kind of like not a ton of stuff going on with like a really good direct comp, larger properties with bigger amenities that were renting for a lot more, and it's been continuing to go up. But it was really cool to finally get one of those done and leased up, and to have it come in. We rented it for $1,200. I had $1,125. That's a pretty significant jump. That's probably, I don't know, 4 or 5% higher. That was really cool to see. So that was nice.
Yeah, that's awesome. What is it that drives you?
There's a lot. I think a few things. I think one is, family. I want to, start a family and be able to just kind of do whatever I want. And, that financial freedom is a big part. I think two, the building something from the ground up, I think is really interesting. The idea that I'm going to be able to look back on this episode, all the different photos and videos in 3, 5, 7, 10, 20, 40 years, I think is really cool. My dad and his family's been very big on like genealogy and family history, and like looking back on all that stuff has always been very interesting to me. So I think being able to look back on my own stuff is going to be really, really cool. I think also too, I know a lot of people that do not have the best work environments, whether it's like very little paid time off, not having benefits, not really having a living wage. So I think being able to build up that business where I can make the changes as I see fit within my own, hemisphere or bubble is really empowering, of, hey, some people don't even get days off when they're sick or paid days off when they're sick, which is just fucking ridiculous to me. So it's like, being able to, employ, even if it's 5 people, 550, 500, I mean, being able to implement the things that I think are how it should be, is, another thing that drives me. So I don't know, there's a bunch of different things, there's smaller things, but those are just most of the big ones.
Yeah. No, I think those are all great things to look forward to. And definitely it's a great perspective as to being able to look back later in life and see your younger self. I'm sure is going to be rewarding in its own sense. And definitely, as you said, being a business owner gives you the chance to improve the lives of others. And I can definitely relate to that quite a bit, because you're able to create the culture and the environment that you'd want to be a part of, right? Mm-hmm. Well, give us 2 best practices. One best practice for active operators that are seeking to find their first deal or one of their first few deals, and one best practice for passive investors that are interested in passively investing into multifamily.
I think the best practice is the same for both. And I think it comes back to that criteria. You got to figure out, what you're looking to accomplish. Like, what is your end goal, right? Like what do you want to hit? What's that 5, 10, 20-year plan, right? Is it X amount of cash flow? Is it X amount invested? Is it certain types of deals? Because until you know what you want to achieve, you can't back into what you're looking for. And once you know what you want to achieve, then you can back into what you're looking for. Then you can go out and find it. So whether it's the certain type of investment in certain areas with certain types of operators, if it's a certain type of deal with a, I think this, it's literally the same thing of sitting down and figuring out what you want and then figuring out how to get there is the best practice for both, really for anybody. But, being able to do that is going to allow you to figure out what you need to do, now, right? I don't know if anybody watching, it's flipped on my end. I don't know if it's flipped on yours, but there's a phrase I came across in, what book was it? I forget what book. I think it was in Essentialism. And it's basically what's important now. And it's just kind of figuring out like, what's the most important thing I can be doing now, but you can't figure out what's important now until you try to figure out where you're going. Because otherwise you're just wandering and just doing whatever comes to. So that would be it for me for both.
Yeah, that's a great reminder to be intentional, write it out, get crystal clear on what you're looking for, and then go and take action after you have it defined.
And I think it's, important too. Like I used to scoff a little bit at 10-year plans. It's really easy to pivot. When I first moved down, I thought I was going to be wholesaling single family and land and shit like that. And then I was going to be, just picking up multifamily on the side. And I got like 3 weeks into wholesaling and I did not like it. So I just, I spent a few $1,000, several $1,000, and I just shelved it. And I said, hey, maybe I'll come back to it. Maybe I find a partner. Maybe I do something in the future. But, very quickly I was like, this isn't, part of the plan anymore. So, nobody's saying you can't pivot.
Mm-hmm. Mm-hmm. Where can listeners find you online and stay connected?
Yeah, pretty easy. If you just Google Chris Grenzig, but easiest place is probably social media. The main one's Instagram, so at chris.grenzig. But I'm on, LinkedIn, YouTube, kind of Twitter, Facebook, TikTok. Not really so much on Bigger Pockets anymore, but I'm there. So those are the easiest places. I have a podcast with my old boss called The Real Estate Investing Experience. You can find that on any platform as well by searching it. You can find it at thereiexp.com. And if anybody wants to email me, my email is Chris, CHRIS, at jag-communities.com. So JAG-communities.com. And just happy to chat and, help in any way I can.
All right, Chris. Well, thanks so much for jumping on the show.
Yeah, thank you.
Thanks for tuning in and joining us on another episode of Operators and Allocators, hosted by the Requity Group, a vertically integrated private equity real estate company. You can find recordings of all shows along with other resources on our company website, therequitygroup.com, also listed in the show notes. A brief disclaimer to our listeners. Information presented herein is for discussion and illustrative purposes only and is not a recommendation or an offer or solicitation to buy or sell any securities. All investments are subject to risk and past performance is no guarantee of future results. The views and opinions expressed by the Requity Group speaker are their own as of the date of the recording. Any such views are subject to change at any time based upon market or other conditions. We hope to see you next week.